Ladies and gentlemen, exactly a week ago, we saw the market regulator make certain changes in rules for startups to list in India. 2021 is being seen as the big year for the startup ecosystem to come of age and head to the IPO street. Is that going to be in India? Is it going to be at the NASDAQ? Is it going to be in Tokyo? Will it be in London? We don't know all of that, but what we are seeing is the market regulator hoping to create depth in the market, hoping to make it attractive for domestic capital. So let me take you through some of the changes that have been discussed since last week. First up, the holding period for the pre-issue capital has been brought down to 1 year. Discretionary allocation of 60% of the issue to any eligible investor, but there will be a lock-in period of 30 days for that. The open offer will be triggered not when there is a 25% acquisition of shares, but 49%. But, and there is a big but, if there is a change in control, irrespective of the size of the acquisition, the open offer is certainly going to be triggered. It's also allowed differential voting rights for listed companies and has said startups can migrate to the main board without meeting the net profit and net worth conditions in case a QIB continues to hold 25% of the pre-issue capital. I beg your pardon, continues to hold 75%. I'm going to be discussing these big changes and more with the founding partner of Indus Law, Gaurav Dani, who's joining us live on Zoom right here on Startup Central. Gaurav, an absolute pleasure to have you on the show today on Startup Central. Indus Law, incidentally, is advising many unicorns on their IPO plans, and Gaurav has been quite clear he's not going to be talking about those, and instead talking about what SEBI has come out with, whether it is enough to actually convince startups and unicorns to list in India and not elsewhere, whether it's enough for startups and founders to list in India and not look at the buzzword these days, which is SPACs. Gaurav, welcome to the show. Can I get your initial reaction? The changes announced by the market regulator, good enough, large enough?
Thank you, Nayantara. It's a pleasure for me to be here today talking on the subject. Let's just first try to understand what SEBI is trying to do here. Obviously, what SEBI is essentially trying to do is trying to create like a NASDAQ sort of a platform, and more sophisticated capital markets in the world. They have an alternate platform, for sophisticated investors. So NASDAQ, help companies like Google, Amazon, become what they are today, huge giants. So in India, we've not had a separate platform especially for technology companies because, as you know, the valuation of technology companies works very differently, how the other traditional more businesses are valued. So what SEBI is trying to do here is trying to create a parallel platform. Now, having said that, a platform for institutional investors did exist in the past. There was, we have the SME platform, which is different, but, for institutional investors, they did have a parallel platform. It didn't really take off because, even though it was meant to be like a light touch regulation, but there were a lot of complications in that. And, the institutional investors preferred to go on the traditional IPO route. So especially for technology companies, a lot of them may not be profitable. They are on the route to profitability. So SEBI introduced this Innovators Growth Platform, a few months ago, where, essentially, it's a platform for companies who have more than 25% of the share capital held by an institutional investor for at least the last 2 years to go the IPO route. So that's what they're trying to do. So it's a step in the right direction.
It's a step in the right direction, but Gaurav Dani, my question to you was that is it a big enough step? Because isn't that what we need? If you're going to have unicorns, whether it is a Zomato, a Swiggy, a Pine Labs, a Nykaa, a Byju's, all of them, delivery, if they're all looking at it, is this big enough? And is it big enough for them to want to list in India?
I mean, essentially not, because there is still a lot of ground they need to cover. These regulations are far away from, what you would see in sophisticated markets like the US. For things like, and the issues very specific to startups. For example, the way the ESOPs work in startups, a lot of startups are not on the route to profitability. There is no visibility on the P&Ls. So again, those are the issues they still haven't addressed yet. So currently, as I see it, it remains to be tested. It'll be a while, when you see anyone
having certain connecting problems with Gaurav Dani. We're just going to reconnect with him, but that was the founding partner of Indus Law, talking about how a lot of these regulations, while important, are not big enough to convince India's unicorns to list in India. And that is something that, of course, the government wants to change. India is home to the third largest number of unicorns on this planet. But there is a big difference in the number of unicorns in India and China, in India and the United States. We are looking to make this ecosystem far more mature. Gaurav Dani back with us after that temporary technical glitch. So Gaurav, you made your point that this is perhaps not big enough to outweigh foreign listing. Now, the other point I want to ask you is, these kind of conditions when you have, when you look at the pre-capital, the pre-issue norms, that how much a QIB must stay invested, when an open offer will be triggered not at 25% but at 49%, but there's change in control, there has to be, an open offer. This is great, it's robust, it's exactly what those on the main board have to comply with. So what is the extra hand-holding that the startups and unicorns would want that would convince them to list in India?
Yeah, so for me, the biggest issue to be addressed is how does a non-profitable company, go down the IPO road? Because traditionally the huge challenge in going down the IPO road was that there was a profitability requirement which SEBI has. Now, in the new regulations, they've not talked about that. Of course, they've eased out on the takeover regulations and the pre-existing capital and all that thing. But for a large amount of startups, they don't see profitability until many years away, down the operational level. For example, in Amazon, companies in Amazon and all are still not profitable. So that needs to change. They need to have a comprehensive platform, framework rather, for companies who are not profitable, and a lot of them in this space will not be profitable for many years. How do they get access to the capital markets? Now, you have the bunch of most sophisticated investors in the world, like the SoftBanks and the likes of SoftBank investing in companies, but they are investing on projection. They're investing on the future. They're investing on the scalability of the business. But again, a lot of those companies on the balance sheet don't show profits. So that, to me, that's the biggest thing that's missing in these regulations, is a comprehensive framework on how non-profitable companies will go down the listing route.
But they have said that if you're non-profitable and if you don't follow the eligibility of the net worth, as long as you have a large presence of QIBs, I think it's up to 75%, you can even migrate to the main board. Isn't that great? Isn't that good? Isn't that what they would want, the startups?
Migration, they've clarified very well how and when the migration can take place. I mean, from my reading of the law, it is somewhat vague. It is something that still needs to evolve. So again, a company an issuer going down this route, needs to have clear visibility, especially even from an investor's point of view, as how and when they migrate to the main platform. Because that's where the retail investors kick in, and which eventually is the route one should be going to. So to my mind, that still is something which needs to be evolved over time.
Okay, so all of this has to happen. Now, the other problem is, why should we only talk about whether what SEBI is doing to have a NASDAQ-like situation in India, is good enough? It's all happening also at a time when Silicon Valley is completely obsessed with the blank check SPAC phenomenon. Now, when that is happening, what's going to take place as far as founders in India go, the startups in India go? There seems to be some buzz about how they're looking at this route. So once again, the regulation changes that have been announced, is that good enough for the startups to not look at the blank check SPAC route?
Question is, interestingly, these new SEBI regulations have come at a time when SPAC, seems to be the flavor of the season. We've had a few successful SPACs. They're more in the pipeline. Unfortunately, I can't talk about those. But I mean, from issuers' perspective, they need to raise the money. They need to raise the money at the right time. In the right space at the right value. Now, currently, where these new regulations are, as I said, they're still to be tested. If the SPAC route continues to be available, issuers who qualify, who fit the bill will continue to go down that route. But of course, as we saw, all these platforms, all these routes have their own appetite. Until the time where there's an appetite for an Indian technology company in that SPAC space, we'll continue to see more startups being driven, to take that route instead of the new regulations.
Okay, so let's see what else is going to happen on this front. Don't forget, last May 2020, we'd seen the Prime Minister himself talk about direct overseas listing for the technology companies. We have seen the market regulator from time to time tinker with regulations to just make it more attractive to list in the country. Gaurav Dani, it's been an absolute pleasure having you on this show today, hoping this is the first of many to follow in the weeks and months to come.
Thank you so much. Pleasure to be here. Thanks.